So just as an FYI to anybody who is here on the webinar right now live, we are recording the event as we do all of our events. And so we do post those up usually within the day. We send them out the next day as well. So if you have to jump off early and you miss part of the webinar, you can watch it later or rewatch it because it is that compelling. So good information to be shared today. All right, let's do this. We are just 2 minutes after the hour and I want to be cognizant of people's time. So let's get started. And then we can end on in a timely manner. So we like to keep these between 30 and 40 minutes. So let me kick things off. I see some names of folks that have been with us before, so you may have heard this before, but this is our webinar series that we have been running for the last 2 months. 6 effective ways to step up your insurance agency ownership game. So thank you for those of you who have attended some of our previous events. This is our last one in the series on agency valuation. So we have Jake Jensen and Kevin Callister from Leavitt Group who are going to be presenting today on agency valuation. And if you would flip to the first slide really quick, Kevin. Just a quick background for anyone who is not familiar with Leavitt Group. We are the 14th largest brokerage firm in the United States. We're now over 180 locations and now in 27 states. We've experienced quite a bit of growth thanks to actually these guys right here in the last year, which we're really excited about. We're now at 312.3 million in consolidated revenue and over 3 billion in placed premiums. So we have grown quite a bit, and you can see there on the map, those are all where most of our locations are. In fact, I don't even think that's our most updated one. So that said, that's a little bit about Leavitt Group. That's all I've got for my little spiel. So I can pass the mic here to, I think Kevin or Jake, I'm not sure which one of you is going to kick it off, but if you want to take it from here and introduce yourselves, the floor is yours.
You bet. Thanks, Heather. Appreciate it. We're excited to be with everybody today. My name is Kevin Callister. I'll get into a little bit deeper intro here in a second as well. Jake Jensen, he and I are going to be tag teaming here, and he'll do the same. But we come to you from beautiful Cedar City, Utah. Southwest corner of Utah is where we're located. That's where the headquarters of Leavitt Group is. And anyway, down in that Red Rock National Park district is our backyard. So we love it down here. Just as Heather mentioned that this slide right here probably isn't the most up to date. The fact we're now at about $350 million of consolidated revenue is where we sit today, and we're excited about that and pushing towards 400 million and beyond. So very much a privately held company, family-owned company by the Leavitt family, and next year will be our 70th year in business. So kind of exciting things happen within the Leavitt Group. Let me introduce myself, and then I'll turn it over to Jake to introduce himself, and then we'll jump in and get going. But there will be a few stopping points that we'll have for questions if you have any. Just go ahead, as Heather said, and use that chat feature, and we'll be able to get those answered and figure out ways to accomplish that piece. But I'm, again, Kevin Callister. I'm the Chief Affiliations Officer with the Leavitt Group. I've worked through different roles within the Leavitt Group, been with the company for about 20 years, just at my 20-year mark, August, a couple of months ago. And absolutely love working here. One of the best decisions that my wife and I have ever made is to stay here in Cedar City and work with the Leavitt Group and go about this. I've been heading up the acquisition side of things for the last 7 years, seven and a half years almost, is when I took that over. And anyway, we've got a great team that we work with as we go about the partnering side of the business. I've got 5 kids. I'm from small town Utah, and my wife and I have 5 kids, and a girl and 4 boys. They're in every level of school that there is known to mankind. I've got college, I've got high school, middle school, and elementary all covered here. So our lives are crazy, as you can imagine. But anyway, just a little bit about me there. Jake, go ahead and give an intro to yourself, and then we can jump in.
You bet. Thanks, Kevin. Good to meet you all, and I hope to have conversations with each of you if possible sometime down the road. I also have a house full of kids. I got 4 of them. kind of opposite of Kevin. I got one boy and three girls, and we also love it here. It's a great place to raise a family. I've been with Leavitt Group here now. I'm in my 19th year, just started my 19th year. I've had various positions within it. My background is in accounting. I have my master's of accountancy from Southern Utah University right here in Cedar City. And over the years, I've had positions within the operations management team. And over the past two to 3 years, I've been working with Kevin and his team in the acquisitions department. And we've had a lot of good activity recently, and things are really, like Heather said, things are really growing very quickly for us. And it takes a whole village to do as many acquisitions as we've done. And so today we're excited to be able to talk to you about valuations and how to increase the value of your agency as you look to potentially make that transition, either in the near future or down the road sometime. So excited to be here, Kevin.
Perfect. Thanks, Jake. All right, let's go ahead and jump in. Driving agency value is that's what we're looking at today. This is kind of the culminating webinar in this series of 6 that we've dealt with and that we've gone through in the past. Each one of those, just want to make a couple of points before we jump fully into this in the slides. Each one of those webinars build up to this. Each one of them are a component that we look at as we drive value within our agencies. And as we go out and partner with other agencies, both now and in the future, these are all components that we're going to look at, that whether it's carrier relationships, the organic sales, the producer, the recruiting, the sophisticated partner style sales process that we go through, the perpetuation process. Each one of those are things that we look at as we value a business. Everybody values a business the same way. I don't care what they tell you. They do it all the same way, meaning it's built off of pre-tax cash flow, or you hear the word, it's buzzword out in the industry now, everybody's heard it a million times, probably EBITDA, or the acronym, I should say, EBITDA. That's earnings before interest, taxes, depreciation, and amortization. And EBITDA is the foundation upon which all values are derived, essentially. Pre-tax cash flow is what they want to look at to see what their returns are going to be, given a certain sales price. And so EBITDA is what everybody will value a business off of. They may give it to you, the value, they may portray that value as a multiple of EBITDA or a multiple of revenue, but it always starts as a pre-tax cash flow type analysis. And then the multiples come into play based off of these other things that we've talked about. You know, do you have a great sales culture? That probably would justify a higher multiple than somebody that does not. Do you have good carrier relationships? That probably justifies a bit higher multiple than somebody that does not, and so forth. So that gives you a little bit of indication as to what goes into that valuation process, just as a foundationary statement moving into this webinar. So today we're going to discuss specific methods, including the bench strength, the growth trends, commission structure, and so forth. We'll get into the acquisition side of things. All of these things will directly enhance the value of your business. And ultimately, this business that you are creating, which is your baby, and that's exactly the way that we love to see it. We love to see you invested and loving it as you would a kid. Ultimately, this business is something that you care about. It's something that you've built from the foundation up, and it becomes a retirement source for you at some future point in time. And so that's exactly what we're going to get into today. Ultimately, there's 4 pillars of a perpetuation or evaluation process or a sales process. We've got the 4 pillars listed here. We're only going to dive into the first one, absent this slide. I'll dive into the other 3 really quickly, but the rest of this presentation, this webinar, is going to be based off of number 1, because it's the one that's most involved. We could probably have something or do a webinar on each one of these 4, but today we're going to focus on the healthy operation piece. Reasonable seller. That makes sense. Obviously, you've got to be reasonable as you go out and sell the agency. I like to compare it to a home sale. Everybody always thinks their home is worth more than it really is, except for right now, it probably is worth that much given the market that we're all living in. But, typically, there's a little bit of a reality check with that whole thing. You always expect it to be higher than what it really is. You've got to be reasonable in that process. An able buyer, you've got to have a buyer out there that is not only willing to buy the agency, but has the deep enough pockets to be able to fund it, cash flow it. They've got the expertise to be able to assimilate it and bring it into their model, and they've got to do so the right way. If they don't, it really makes life miserable for the seller in that case, because the seller is going to have to jump back and get involved if something goes wrong there. So an able buyer is critical. And then lastly, we've got an effective transfer mechanism, which is just simply stating it. It's basically, hey, I'm going to give you my agency, and in return, you're going to give me X, X being cash, stock, the old Ford out in the driveway, whatever it is that makes sense to you as you go out and sell your agency, you're going to have something that's given to you in return with that. But the healthy operation is the piece that we're going to focus on today, and that encompasses margin and encompasses growth. We use a two-pronged growth approach that we'll talk about here a bit later. But Jake, tell us, jump in a little bit here and start talking to us a little bit about margin, what goes into that side of the business.
Yeah, thanks, Kevin. As Kevin said, EBITDA is the most important basis or foundational piece in valuing an agency. Everybody looks at EBITDA. They want to make sure that if they buy an agency, that it's going to cash flow for them, and it's going to make sense, and they're going to make the returns that they need on any investment. And so it starts with EBITDA. It's difficult to achieve strong EBITDA margins if these things on your screen aren't balanced and taken care of. Your personnel costs, which include your commission structures you pay to your producers, the salaries you pay to your employees, and also the amount of money an agency pays in value-add resources. We all understand that, and to compete in this world, to get good clients, you've got to have some really strong resources. And so an agency's ability to balance all of these expenses directly impacts that EBITDA more than really any of the other expenses an agency has. So we've come up with this graphic to kind of visually put it out there and help you understand what we're talking about. As you'll see, to achieve strong margins, if you look at the last column where the strong margins has an X, it's difficult to achieve strong margins if your producer comp is high and the resources that you're paying for are high. Okay, so let me hurry and define what high producer comp might be. At Leavitt Group, we have a standard that we pay our producers. It's 50% new and 25% renewal. So of the commissions the agency receives in total, we pay 50% of that the first year to producers and 25% the second year and beyond. We do that. That's competitive within the industry. It's not the highest. It's not the lowest. It's competitive, but it's a good place to be because it allows us to have some money to be able to pay for our resources as well. And when you see resources, what I'm talking about is everything from support staff salaries to management overhead compensation. But more directly, even, it's loss control, it's claims advocacy, it's lead generation tools that often are provided to producers to be able to grow their books of business. An agency can let that get out of hand a little bit if they're not careful, because they want to be able to be everything to every client. And so it's important for an agency to really have a good handle on the resources they offer and that they pay for. And so the purpose of this slide is really just to show you that if you want to achieve a strong EBITDA and strong margins, you can't have it all. You can't eat your cake and have it too, as they say. You have to figure out how to balance your producer comp and the extent of your resources. Kevin's going to take some time now and talk more about growth initiatives within an agency that can increase the value. He's going to talk about organic growth, and then we're going to get into some acquisition growth. So go ahead, Kevin. Kevin, you're on mute.
Sorry, man, I was well on my way there. Thanks. Yeah, you heard me make a comment earlier about a two-pronged growth approach. This is something that we employ heavily within the Leavitt Group. A two-pronged growth approach will be organic growth, meaning producer and sales initiatives. And then we've also got the acquisition growth side of things. We're going to first hit this organic growth side of things. Very, very important to an agency and its valuation process. And we'll show you this a little bit later as well, where we're going to show you two agencies side by side, maybe one that doesn't, one that does have organic growth, and what it would look like from a valuation standpoint. But here we've got the producer side of things. And the big question is how many producers do I need? How many producers should I be hiring? What does it look like? How do I calculate that? This is a slide here that we're going to go through. The next two actually are the same slide, just with different revenue numbers, different sized agencies. We've intentionally used a very large agency or commission revenue number here because we wanted to prove the point. And then again, I'll bring it and scale it back down to probably something that's closer to home for each one of us here in a second. But let's assume that we've got a commission revenue agency of $10 million here, okay, $10 million agency. Let's further assume that we've got 90% retention in this agency, which is probably fairly standard. Anywhere from 88 to 93, 94% would be kind of in that average range. So let's assume 90 for ease of math. That means that just 10% leakage is going to dictate that $1 million is going to walk out the door over the course of the year, meaning we're going to be left with a $9 million book of business. Okay. Let's assume also that we want to have a 7% growth goal. So $1 million is just going to be used of new business to be able to just bring us back up to our $10 million number. But let's assume we want to grow at 7%. So that means we've got to get to $10.7 million at the end of this year. That means we've got to write new business of $1,700,000 throughout the course of this year. Let's assume 2022 is the year that we're looking at. So in 2022, we've got to write $1.7 million to grow at a 7% clip. Okay. All right. Let's also assume that we've got 15 producers in this shop, 15 producers that are active. They're out there writing and hustling for new business and so forth. And that the average that these the average of these producers, these seasoned producers they're writing about $100,000 each on average. Now, it may seem like a lot, it may not seem like a lot. Within our model, we're typically able to accomplish this with our producers, producing $100,000 and up, and that's what awards them with a sales trip. We have about 80 or so producers that go on our sales rewards trip each year. So this is a very doable number, something that can happen within our model often. So $100,000, that means that if you've got 15 producers at $100,000, that means we've got $1.5 million of new business. We needed $1.7 million, as we talked about. And so we're $200,000 short over the course of the 2022 year. $200,000, how are we going to come up with that? How are we going to bridge that gap? We've got to go out and we've got to hire some producers, okay? And so before I jump into these numbers, let me just say this, and you may have heard this in a previous webinar with Brent on there, but the fact of the matter is average in the industry is about 33 to 40% of those new hires, those new producer hires stick. That's about average. And so we perform at about a 50% clip with our model, with our platform that we provide. And so we're going to use that number. Even with this 50% clip, which is very good, in order for us to go out and get two new hires, two new producers within our model that are going to stick, that likely means that we've got to go hire 4 just to have those 2 stick around and allow for that shortfall to be bridged, that gap to be bridged. That's a big deal. Jim Kelly asked right here, is that $100,000 of premium or $100,000 commission? That's $100,000 of commission. Great question. We're going to be speaking in terms of commission throughout the course of this webinar here. So that's $100,000 of commission, which would equate into, call it $750,000 to $900,000 of premium in a given year, depending on the commission rates with that particular carrier. Thanks for that question, Jim. So we've got to go out and we've got to hire 4 producers just to get the 2 to do this. This is a typical model or a calculation that we would work through in a given year to help us figure out our new producer hires. Now let me move to this next slide and again bring it down to probably more of a level that each of us would be playing in here on this webinar. Let's assume now that we've got a commission revenue of $1 million. $1 million agency, same 90% retention, meaning 10% is going to walk out the door. We're going to be left with $900,000 of business at the end of the year. And that same 7% growth goal means that we're going to want to be, or we want to be at $1,070,000 of book of business at the end of 22. That means in this case, we've got to go out and we've got to find or write $170,000 worth of new business over the course of that year in order to grow at 7%. Let's assume that we've got 2 producers in this scenario and that they're writing an average of $60,000 of new business in a given year. Okay, this is something that would probably be that each of you could subscribe to and look at. If you got 2 producers at $60,000, that's $120,000 of new business. That means our shortfall with the 120 is 50,000. We needed 170,000 to be able to get our new business number and our growth goal. That means we're $50,000 short. In this case, we would need to go out and we'd need 1 successful producer to be able to bridge that gap, allow us to grow at the level that we're seeking to grow at. And at that 50% clip within our model, we would need to hire 2 producers to do that. That's something that's fairly standard out there. And this is a calculation that you'd want to go through and something that you'd pay attention to each year, year in, year out, as you look to grow and build that sales machine or that organic growth machine that you employ. Now, what happens if we end up with 2 that stick? Man, hallelujah. That's a great thing. That's count your many blessings at that point in time and run with it. You've got 2 producers that are out there extending themselves, leveraging themselves, and writing new business for you well into the future, which is a great thing at that point in time. And you should be able to cash flow that because they're successful in that process. Now, there's a term for this that Jake's going to run into. Jake, what's this term called, and what's a healthy investment look like within a particular agency? How much should we be investing?
Yep. The term is NUP. Some of you may have heard of this term. It's NUPP right there on your screen, and it stands for Net Unvalidated Producer Pay. NUP is, in simple terms, is compensation paid to a producer above and beyond what they would make if they were making commission only. Okay. So when an agency hires a new producer, for example, that's when the bulk of an agency's NUP is spent. Okay, so when we hire a new producer, we can't just pay them commission only from day one, because it takes, I mean, even if they come out and write a ton of business right at the front, it takes a couple months for the agency to receive that commission from the carriers. And so they need to have a bridge. They need to have a compensation bridge to get them from where they are now, being hired on day one, making 0, to, you know, a few years from now, in most cases, to where they can justify, where we can justify paying them commission only, and they can live. So that bridge compensation is called NUP. Anything above and beyond what they would earn on a commission only basis. Okay, so sometimes this NUP is called a salary, sometimes it's called a draw, sometimes it's an enhanced new business commission. Whatever it's called, NUP is deemed as an investment into future growth for the agency. If an agency pays too much in NUP and they are hiring too many producers or paying their producers too much, that's going to dig into that EBITDA. That's going to dig into those profitability standards that we talked about that drive an agency's value more than anything. And so you don't want to be paying too much in NUP, but at the same time, you don't want to be paying not enough in NUP as well, because that would indicate to a buyer that you are not committed to investing into organic growth by hiring producers. And so the industry has come up with an acceptable range, if you will, and that's on the screen there. 1.5% to 3% of your commission revenue should be spent each year in net unvalidated producer pay, in investment into new producers. And if an agency is doing that, the buyer of your agency, the one valuing it, will see that and say, hey, that's a good, healthy practice. That's something that we adhere to as well. And that's something that can justify a little bit higher price. And so that's how NUP works, and that's how we measure what Kevin was just talking about. Is an agency willing to invest into producers? And so let's take a real quick pause here Heather, have any other questions come in on the chat up to this point? Or if anybody has any questions, now would be a good time to throw them out there.
Yeah, nothing in the chat right now, but if you'd like to send your message in the chat, go for it. If you'd like to actually ask your question, I can unmute your line. So just send me a message directly in the chat to unmute your line if you'd like.
Okay, perfect. And if anybody has any questions and we need to go back a slide or two, that's okay. We can do that as well. Also at the end, we'll make sure there's enough time for any questions about any piece of the presentation today. So Kevin's now going to talk a little bit about the other type of growth, the two-pronged growth approach. We just talked about organic growth, producer hires. Now he's going to talk about acquisition growth and go through that business.
All right, perfect. So acquisitions, this is a fun one for us to talk about, obviously, because we deal in this world day in, day out. Really, there's a couple of kinds of acquisitions. There's a margin producing acquisition or a financial play, and then there's one that brings with it producers or expertise, which is a growth play. The fact of the matter is that the best acquisition brings both. That's what we seek. But critical to that whole thing is if it doesn't bring with it growth, we got to make sure that the financials work on that thing. You've got to make sure that you can cash flow and that it's give you a healthy dose of return into the future. That's a critical piece there. But again, both is what we would seek to do. Let's jump into an example. This is a real agency of ours, one that is housed within the Leavitt Group that we've partnered with. Partnered with this agency several years ago. We created this slide actually a couple of years ago. We haven't updated it and ought to. We'll do that here, but the fact of the matter is the affiliation occurred probably about 15 years ago at this point in time. I want to show you exactly what happens when you have acquisitions within an agency, what can happen with the value of an agency. This particular agency, when we partnered with this gentleman, it was a $700,000 commission agency. Okay, it had about $42,000 worth of contingent commission in there as well. So its total revenue was about $742,000 at that time, 15 years ago plus. It had EBITDA, it was kicking off EBITDA. Remember that term that we've got out there, EBITDA of $164,000. So about a 22% EBITDA margin. Okay, and then it had a balance sheet worth about $157,000 at that point in time. Now, enterprise value right here, this is the enterprise value is the value that is attached to the book or the EBITDA, okay? It doesn't include any balance sheet. This is where the multiple comes into play. Now, remember 15 years ago, values or multiples weren't then what they are now, okay? And so if you were to back into this, what you're gonna see is a 5.2 times multiple that was used on this EBITDA. Man, that just doesn't happen anymore in today's day and age. Values are much higher than that. But we wanted to show you exactly what happened with this particular agency. So you take the 163,982, multiply it by 5.2 times, and that's how you get your enterprise value of $852,000. You add the balance sheet and the working capital into play. We won't dig heavily into that. We can explain that on further conversations. But when you add those three together, the balance sheet, basically you've got a total agency value of $962,000 is what this agency was worth that this gentleman owned 100% of. We bought 60% of this agency at that particular point in time, leaving him with 40% interest in the agency. Now, with that 40% comes a lot of autonomy and so forth. He still runs the agency, but we were able to partner at that point in time. We were able to bring our added value services and platform to the table, and he continued with the relationships. Now, what's happened since then over this, again, 13 years time frame when this case study was done, this agency, now he owns 40% of the agency. It's grown because of acquisition and organic growth. It's grown to $2.8 million worth of revenue. Total revenue is $3.26 million. So it's got about $460,000 of contingent revenue in that agency. And it's kicking off EBITDA of 986, just shy of $1 million. So you can see an EBITDA margin there, an uptick from 22 where he was at before to 30% in our model, exceeding 30%. And then look at the net worth, what's happened as well. Our ability to build a net worth within that agency of over $2 million. Well, when you pull an enterprise value on this, we just use the same 5.2 times multiple just to create an apples to apples comparison. of the two, when you use that same multiple on this 986 as we did on the 163, it creates an enterprise value of $5.1 million for the again, total agency value. You add the net worth and the working capital, and it creates a total agency value of $7.2 million compared to the almost $1 million that was in there before. Now remember, he owns 40% of this now. We own 60%. And so his value, the 7.2 multiplied by the 40%, his value is $2,888,000, his 40% value here. You add to that the 577 that he got initially when we bought 60% from him, and he got total value from the affiliation of the Leavitt Group just shy of $3.5 million. Okay. Now, if he would have gone out and just kept it 100% and just grown at the 3% growth rate that he was accustomed to in the beginning over that 13-year period, he would have grown his 962 to be about $1.4 million in value. The delta between the actual value that he received and what he would have had he kept it is over $2 million. Okay. Again, the reason why that worked so well for him is because of both organic growth, but also acquisition. We were able to go out and acquire a bunch of acquisitions over that process and bring them in, roll them into his business, which has been a great thing for him.
Kevin, can I interrupt you for just a minute?
Go ahead.
You do have a question. Yeah, I didn't want you to get too far down the road. On the previous examples, there's a question from Stephen Helms, and he was asking if both of those examples from the previous slides assume a 0% increase in renewal premiums.
Yes. Well, this one does. This one does not. This would assume a reality of increase in premium over the course of that period of time. So you're absolutely correct. There is some market-driven factors in there. Now, I think it's important to note that over the course of this period of time, we had both hard and soft markets occur. You'll recall the 2008, 9, 10 timeframe is when we had a huge softening of that market where everything, and that was from an economic standpoint, was detrimental to a lot of agency value as well. But yeah, there's hard and soft markets driven throughout. Great question. Great point. Any follow-up to that? You good there? Okay.
I think we're good.
Okay, so how do we go about this process? There's two ways to go about finding acquisitions. You've seen how important it is, how much it can impact your value. Here we've got a couple of different scenarios. Dialing for deals, where we're basically going out cold calling a bunch of deals, and here we've got a more targeted outreach. These numbers come to us, by the way, from Reagan Consulting as our source. So these aren't numbers that we've come up with. These are numbers that Reagan Consulting has come up with and through studies of their own. And basically what they found is when we go out and dial for deals, just cold calling agencies like crazy, if we've got 128, basically what they're looking to get to is 3.7 LOIs. What that means is to get to 3.7 signed LOIs, we've got to have 128 phone calls. It's going to pare down to 26 management meetings, 3.7 LOIs on average, 2.3 closed deals. So 1.8% of our initial contacts close. And which ones are successful? It actually pares down to 0.7. So 0.6, 0.6% of those initial contacts turn out to be a successful transaction based on their estimation. Whereas you get a targeted outreach, somebody that you've got relationship with, somebody that you are fostering that relationship over time. We've got 21 contacts in this case, paring down to 14 management meetings. There's the same 3.7 signed LOIs. And then you look at the closed deals, we're at 3.3. We're at 15% on that one versus 1.8. 2.7 of which are successful. That's the piece of this slide that I love the most. The successful deals are the ones where we're targeted, and that's the one that matters most. It's not this closed deal. That one's not the one that matters most. The one that matters most is a successful deal. And here we've got 12.4% of those that are targeted. Those are the ones that we're getting to be successful transactions. Now here's just a high level, again, comparison. We've got a higher LOI to contact rate in that assumption. We've got a higher close to LOI rate in that assumption. You can see the numbers here. And then there's the success rate right there that I was mentioned. That's the most important, 82% versus 30% from a success rate. That's comparing it to the signed or to the close. 82% of those are successful versus 30% on this other side, the dialing for deals. So here's the keys to acquisition sourcing that you want to look through. Ultimately, you want to keep the top of your funnel narrow, meaning go after those that you have relationships with. Spend the time with those that you're friends with. Focus on those personal relationships, meaning just because they're a competitor doesn't mean that you guys can't be friends. That's a great thing when you have a friend in the industry. Go out and generate those relationships. It's not uncommon for Leavitt Group to partner with people that we've had relationships with for 10 plus years. That happens within our model. Differentiate with culture and role. It's important to note that dollars are important for everybody. Sales price is important for everybody, but you've got to have culture that come along with it. Without that culture, that's the difference between the success rate on those closed deals. When you have culture fit, it's much more likely to be a successful transaction. And then lastly, find the deal killers fast. That's a big deal in this. It just allows you to minimize your time and make your time more efficient as you go through this acquisition sourcing process. Any questions on any of that before we leave the acquisition side of things? Looks like one just popped up here. That was Heather reminding. Okay.
That was me.
Okay, perfect. Awesome. Okay, so Jake, here we've talked about some organic, we've talked about acquisition, we've talked about margin. How do we measure all of these? How do we know if we're getting too heavy towards one side or the other? What do we do to go through that process?
Yeah, perfect. Hang with us here. We got 4 more slides, everybody. We're getting there on time. Before we do that, though, Kevin, we just had one more question come in. Maybe you want to take that. It's back on the other slide that you were on. It's Kim Unger. She says, you mentioned the EBITDA multiple of 5.2. It seems you think is low. What would you feel is a reasonable EBITDA multiple?
Yeah, so great question, and that's the question everybody wants to know as it pertains to their agency. Remember what I'd said here is that every agency is a little bit different in what they bring, and the multiple depends on the sales culture. The multiple depends on the carrier relationships. The multiple depends on those risk factors that we're going to be looking at. And so 5.2 is something that you don't see a whole lot of today. Usually the minimum that you'd see today is somewhere around a 6 times multiple. Maximum would be somewhere up in the 9 times range when you're getting into those higher level multiples. So that gives you a range. I realize that it's, you're probably looking for something a little bit better, but with all of those other parameters, you can literally have a range of anywhere from 6 to 9 or even a little bit higher, depending on those other elements of your business.
Perfect. Thank you, Kim, for that question. So like Kevin said, we've talked about EBITDA margins. We've talked about growth, both organic and acquisition growth. Well, how do we balance all that together? How do we know if our agency is on the right track to get as much value as possible when that time comes to sell? We have a metric, another industry metric, again, I believe this one's from Reagan Consulting as well. It's called the Rule of 20. And before I get into how to calculate it, if you think about it, when you invest heavily into growth, that's usually going to negatively affect profitability because of those investment dollars going out. Conversely, profitability can be high if an agency doesn't invest. Okay, but we've just talked about how that can hurt your value as well if you're not investing into growth. So how do you balance all of this? Again, it's the Rule of 20. So the Rule of 20, the calculation is there on your screen. You take half of your EBITDA percentage and you add to that your annual organic growth percentage, okay? So if you go to the next slide, Kevin, this will kind of give us a scatter plot of the Rule of 20. You see that slanted line. If your agency hits 20, a score of 20 on the Rule of 20, your agency will land on that line. At its extreme points, well, first of all, on the x-axis is the organic growth. You'll see down there, you got 0%, 10%, 20% organic growth. And then the y-axis is the EBITDA margin. that your agency has, your profitability. And so on the extremes, if you have an agency that is growing at 20% every year, but has 0% EBITDA, well, the rule of 20 score for that agency is 20. Remember, it's organic growth plus half of EBITDA. Conversely, if you want to be on the top side of that slope line, you could have an agency that is 40% EBITDA margin and 0% growth, and that's going to achieve a score of 20. Both of those agencies, even those extremes, have value. They have value to a potential buyer. A 40% EBITDA agency that isn't growing is still, that's kicking out a lot of cash. A 20% growth agency with 0 EBITDA is growing so fast that a buyer is going to say, yeah, we can make that work. We can make our returns on that. And so really, if your agency is anywhere on that rule of 20 line, you can feel confident that you are balancing all of these metrics appropriately, and that you will fetch an EBITDA multiple or a revenue multiple. The value of your agency will be maximized if you can place your agency on that line or above. And so that's when valuing your agency, make sure you have a balanced approach, and you can see how balanced it is by putting your plot on this scatter plot. And so we've got 2 more slides left. Kevin's going to show you a couple of examples of how this ties in with everything else we've talked about so far.
All right, yeah, we'll get through these 2 and then let you guys get back with your day here. But here, what we're attempting to show you is that not all agencies are valued the same, and this is ultimately what we've been talking about through the course of this process. Here you can see that we've got 2 agencies, both of which have $1 million of revenue. And so a lot of people think, well, I've got $1 million agency, and my friend was $1 million and he got this. Well, why am I not getting this? You know, what's going on? And here we got the only difference between the 2 is EBITDA percentage. This one's at a 30% clip, has $300,000 of EBITDA. This one's at a 25% EBITDA margin and has $250,000. If you use an EBITDA multiple of 7 on this, you can see what happens from a value standpoint. This $1 million agency, agency 1, has $350,000 more value than agency 2, sheerly because of the delta in the EBITDA percentage between the 2. You can see here it's got the same NUP, it's got the same annual growth. On a rule of 20, this one's at 22. It's above that 20 mark. This one's a 19.5. It's below that 20 mark. So you can see that's one example. Second example here, agency 3 and agency 4. With this one, we've actually got the exact same EBITDA or revenue, the same EBITDA percentage, the same EBITDA dollars, obviously, same multiple, same value. You know, if you use that multiple. But our point here is you look at something here where you've got NUP. These guys are investing in growth. It's got a 7% growth, meaning its trajectory is steeper than this one, agency 4. And so you've got a rule of 20 of 22 here versus 15. The fact of the matter is that the likelihood is that these wouldn't be valued with the exact same multiple. The likelihood is that this one would probably be 6.5 and this one would be 7 or 7.5, something like that. It's going to create a delta in the value between those agencies. And so those are all, it kind of drives home the fact, or all these things that we've been talking about, sales culture matters, acquisition and growth matters. It brings with it an energy and the ability for buyers to attach a higher multiple to those agencies that have a higher and steeper growth trajectory coupled with margin within the agency. So that brings us to the end here. I just want to pass along our gratitude that you would jump on, that you would trust us with your time. We hope it's been a productive use of your time. We feel it has been on our side for sure. So we'd love to talk with any of you. If any of you have any questions, then we're happy to do so. You can reach out to us and get us, and we'll talk at any point in time. But Heather, back to you.
Yep. All right. Thank you, Kevin and Jake. So with that concludes today's webinar. You can see some contact information here on the slide. If you have any questions, would like to speak to us further, please give Hudson an email there, hudsonduncan@apiglobal.com. Visit us online. By the way, we just launched a brand new website, got lots of great new content out there, a lot easier to find things that you might be looking for, both around the webinar topics that we've had and a lot of other things. Also, make sure you follow us on LinkedIn. We're pretty active out there. So just do a search for Leavitt Group and you should find us right away. This is the last series in the webinar, or rather the last webinar in the series. We may be bringing more, so keep your eyes peeled for that. But until then, thank you. And that concludes today's session. So thank you, Kevin and Jake. Everyone have a great day.
Thanks, everybody.
Thank you guys. Goodbye.
Take care. Have a great Thanksgiving.
Okay. Thanks.